Hello, everyone, and welcome to our Polkadot webinar series. We have a very exciting show today, and we're joined with by Dave Sedacca, lead at Polkadot Capital Group and Director of Finance at Parity Technology. We have Adam Blumberg, co-founder of Enclave Digital Wealth, and Nico Arevalo, who is co-founder and CEO at Velocity Labs. We'll focus today on how Polkadot's modular architecture and interoperable block space is reshaping on-chain capacity and demand. We'll look at everything from the evolution from Bitcoin to early Ethereum to Polkadot's design choices, what it meant, highlight the infrastructure decisions and metrics that actually matter, and try to unpack what's driving block space consumption, right? So we'll try to look at RWA, tokenization, private credit, global settlement, collateralized strategies, really trying to spotlight the builder pipeline, such as Velocity Labs product and their DeFi builder program, and try to see how those developments translate into practical takeaways for RIAs and their clients. So really trying to keep it very practical and focused on building better financial products and financial health. Before we get started, as usual, none of the information contained in this webinar is for informational, is intended as investment advice. It's all for informational purposes. So please take everything we say with a grain of salt, do your own research, et cetera, et cetera. And without further ado, let's get started with a quick round of introductions. And whoever wants to go first can go first. Could you each briefly introduce yourself, your role, the organization you work for, their goal, and how you relate to supporting the Polkadot ecosystem?
Awesome. Well, I'll kick things off. Dave Sedacca. I've been in the Parity Polkadot ecosystem for a little over 3.5 years now, overseeing finance and treasury at the Parity Group, which is the labs company behind Polkadot. Recently, mid this year, we established a division called Polkadot Capital Group. This is really in the way of resonating with a specific type of audience. Now with the U.S. regulatory clarity and thinking about educating specific groups across issuers, asset managers, RIAs, with Adam and his team, to really think about the convergence of TradFi to DeFi.
I can go next. Hey, everyone. Thanks, Sacha and the team at the TIE for the invitation. Nico, I've been in the Polkadot ecosystem already for a good part of 5 years. I've been all over. I started at a Parachain leading business development, and then I moved over to Parity Technologies, company where Dave used to work at as well. I was head of DeFi there, so overlooking all the DeFi strategy on behalf of the ecosystem, getting more teams to build DeFi products on Polkadot. And then about 18 months ago, we as an ecosystem took the decision to decentralize Parity's operation. So one of the functionalities that we decided to spin out was the business development function, and more specifically around DeFi and infrastructure. So that's the genesis idea of Velocity Labs. So Velocity Labs is a Polkadot contributor, but from an independent standpoint. And as I mentioned, so we focus solely on DeFi and infrastructure, make sure that Polkadot has the needed infrastructure for financial products to be able to launch on Polkadot. And we also have an engineering team to make sure that we have technical solutions to the problems that our customers have.
All right. Thanks for having me on, everyone. My name is Adam Blumberg. I'm a CFP, which is Certified Financial Planner. For the last, 5 or 6 years, I've actually been teaching crypto and blockchain and Bitcoin to other financial professionals all over the world. We've taught thousands of financial professionals, helping them understand crypto and understand where it fits in portfolios. I have been particularly excited for the last several years about what it might look like when investors start having more assets on chain, and those assets could be native crypto assets, like Bitcoin, ETH, and DOT. They could also be, so-called tokenized real-world assets. They could be tokenized liquidity, tokenized investments into liquidity pools. And in thinking through all that, we decided this was the time to launch a registered investment advisor called Enclave Digital Wealth, which actually gives us the ability to manage client investments, manage client assets, both within qualified custody. So if you're in the US, you might know of Anchorage, BitGo, Crypto.com. If you're outside the US, you might know of Tetra or Zodia, but also be able to manage client assets on chain. So we manage client assets. Most of our clients are native in crypto at this moment, but we foresee this future where most people's assets are going to be on chain, and therefore they're going to need some sort of advisor that can actually help them manage their wealth in this world where most of their assets are going to be on chain.
Wonderful, super. Well, I think that's one of the best intros we've had so far, and very, very, very clear. So let's shift gears and start with our first topic for today, which is going to be around blockchain infrastructure and the underlying technology. Before we dive deeper, so Dave, let's start with you. Parity Technologies was founded in 2015, around the very close to when Ethereum was founded. Was launched, right? Like not that long, just a couple of years after Bitcoin. So what are the unique challenges that Polkadot has been trying to solve that earlier blockchains could not, and how has that evolved over time?
Yeah, of course. And I think, it all starts with Gavin as he, created the Ethereum virtual machine and constructed the Solidity smart contract language, and co-founded that with Vitalik and other founders. But I think he saw early on the limitations of his vision on what he thought blockchain should be able to solve for both builders and users in a decentralized world. And I think that starts with differentiation between a monolithic blockchain and a modular blockchain. Whereas Ethereum, if you think about this, it's much more centralized. Versus a modular is kind of where Gavin wanted to build, is actually having all these different components that can construct an actual ecosystem, a network of networks. And essentially what his vision was essentially to create a shared security model. All these businesses that want to deploy, they don't have to worry about that. They focus on what they can do best. Building their own, L1, we call it a parachain in Polkadot, and build from the actual building blocks from the ground up. Thinking about unit economics, thinking about creating their business on a chain, however they want to, launching their own tone and kind of offering services like that. So, and also governance. Governance is very important. Governance on Polkadot is not over a YouTube channel with a couple of people just raising their hand and saying aye or nay. It's actually every token holder in Polkadot has a vote, and that's done very transparently through an open governance process, I think, which is super unique. And I think it really helps with compliance and risk when you're looking at upgrades from a technical perspective, but also other things that people are looking to do to support the ecosystem on chain.
Yeah, and I think there are lots of innovations at the voting mechanism level that Polkadot brought to the table. But the big topic these days has always been regulations are here, institutions are finally there. So if you're a financial institution, right, what are the key metrics that you should focus on when it comes to evaluating a blockchain ecosystem?
Yeah, I mean, I think it starts off with ease of access. It's risk, and from a compliance standpoint, do I have the tools and resources to be able to bring things on chain and actually operate within an ecosystem with checking those boxes? And I think, it starts with different wallets, right? What wallets are available? What custodians? What type of rights do I have to do? Adam will talk about that later around how they work with different wallet infrastructures while managing client assets. It's about the on-chain risk, right? I think you talk about potentially bridging risk when you look at an ecosystem like Ethereum. In early days, in order to bridge from one ecosystem or one chain to another, you had to rely on custodians or multi-sigs to actually see that your assets are being transferred. Versus in Polkadot, we have native interoperability through a messaging platform called XCM. So you can navigate from one blockchain to another to use services within Polkadot without bridges. And also, we've introduced another company called Hyperbridge, which is super unique, that we can bridge to other ecosystems through a proof-based cryptography method that doesn't rely on any single point of failure, which I think is really, really unique. So having the risk, the compliance, the pressure-tested ecosystem that sees that value can move around in a way that they will be comfortable with deploying strategies.
Yeah, and the other thing I was going to add here is that I feel one of the mistakes we've made as an industry is taking a one-size-fits-all approach when we mention institutions. And I think we in the crypto ecosystem, we're big fans of saying institutions are coming, but not really thinking about like, okay, what type of institutions, right? Even within just the financial realm, there's a lot of different types of requirements that different institutions are going to need, right? And I think that's where the value prop of modularity comes into place. I mean, us as an ecosystem, we have to try to take a generic approach and see like, okay, what's the common denominator in terms of technical requirements and business requirements to make sure that we meet the majority of them. And if we go through that exercise, I think quality of block space is one that starts to be more commonly mentioned around institutions. Quality of block space is basically block space that it's always going to be available, it's going to be safe, and it's going to be predictable. And if you look at it under that lens, then you can start to kind of filter out some of the ecosystems that might have scalable block space, but they're not safe, or they're not decentralized enough to be safe for an institution, or they're not modular enough. They're too restricted by, I don't know, the EVM or whatever it is. So I think that's where we start to play an important role. And I think that's where Polkadot's vision starts to kind of really materialize, because we're one of the ecosystems with the most scalable block space. It's also very modular. The substrate, the Polkadot SDK, we renamed it, but the framework to build blockchains on Polkadot is one of the most performance and customizables, either to become a parachain or to just launch your own layer one using the framework. And then it's available. Polkadot hasn't really gone down since inception. So that's I think one of the, at least one framework to look at what institutions are looking to when looking for a blockchain ecosystem.
Yeah, and in addition to that, getting that block space and safe and the safety aspects, you need also scalability, right? And operational efficiencies for people who use that block space. So how do you measure that scalability and operational efficiency, right? And do you have benchmarks for that? How does that resonate with the types of benchmarks or guides that institutions have?
I think we come back to this. Some call it vanity metrics. Some really try to flex on it, but yeah, transactions per second. But it's really hard to kind of actually know exactly what that means. In our case, we have to pair it with another metric, which is I mentioned it before, but availability of block space, which means always being running and alive. That has to be part of scalability, because some of the issues of scalability come when throughput is too high and you start having bottleneck issues. And the other one is cost predictability. I mean, back in, I don't know, 2020, when block space in Ethereum started to skyrocket, then cost in terms of cheapness started being a differentiator. Fast forward until today, all block space is cheap. There's just an abundance of it. So if you go to Solana, if you go to Stellar, if you go to any layer 2, you're not paying that much in terms of transaction fees. But then the differentiator becomes is predictability of costs. And that's where scalability plays a role, right? If you're cheap when there's low volumes, but when things spike up, your prices start to go up. From an institutional perspective, it's just really hard to build the business around the unpredictability of cost, and more in the scale in which costs change in crypto, right? It's not like a couple bips; it changes the orders of magnitude more, right? So I think those are the ways in which we can measure scalability from an institutional perspective.
Yeah, and I think just to add to that, we recently launched an initiative called Elastic Scaling. So basically, the unique part about Polkadot today is you rent block space when you need it as a business. And if I think about Elastic Scaling, it allows you to scale up during peak seasonality. If I were thinking about a business, you can borrow additional block space when you need it, and then you can go back down to a point where you just run your business efficiently, right? And that also then streamlines into cost and operational structure.
And let me just say that's really interesting, Dave, because I oftentimes, as I said, I've been teaching this for a while, and oftentimes I'll go back to my analogy of the internet. And if you look at something like this elastic scaling, this ability to buy extra space when you need it or when you think you'll need it, what my mind first goes to is, if you all remember, several years ago, Victoria's Secret actually did an online show during the Super Bowl, during halftime of the Super Bowl, and it ended up crashing their servers because they actually didn't have enough infrastructure for all the people that were watching, and there wasn't really the ability at that time to purchase, some level of infrastructure during that certain time frame. And obviously after that, everyone kind of learned, okay, when you're going to have some sort of live event where you're going to have millions of people watching, you need to make sure that you have the bandwidth for it. So I think what we've learned in the past, as you mentioned, Nico, 2020, DeFi summer, 2021, when we had NFTs, we had DAOs. What we're learning is we really need to have that flexibility when it comes to the utilization of block space. When things like U.S. Business hours, Asian business hours, when there are big movements, when there are political elections or something like that, you need to have the flexibility to be able to expand your block space or shrink your available block space based on what you need. And I think that's going to be extremely important in the future of companies and of industries and even of individuals choosing which chain they're going to use. Is having that flexibility, I think, will be really important.
Yeah, I mean, an interesting aspect of blockchains, right, is when you look at more traditional systems, you get too much demand and too many people sending orders, right? It crashes when it can't handle the heat. In blockchain systems, right, like when you have an auction mechanism for gas fees, well, technically the system is still operational. It just becomes prohibitively expensive to transact, which is quite an interesting shift in how things are turned on their head. But that being said,
can I add an analogy there?
Sure.
So this is from the standpoint of a blockchain developer, right? Because from a dApp developer, you still are kind of, let's call it, you're pinging the changes when you need to change or access state, right? So it's elastic in a way, right? But from a blockchain perspective, you're constantly producing blocks, right? Which means you're constantly getting charged by producing that blocks on behalf of validators, right? And then that's just a constraint that we had from the beginning on the way blockchains were created, right? Which doesn't really equate with the way that businesses work nowadays, right? So one analogy that I don't remember where I heard it, but today's day and age blockchains, it's like you have a little startup or you have a little mom and pop shop, but you're forced to go and buy a warehouse, right? Even if you don't need it. That's what like developing a blockchain today is. You can really develop it with how much demand you're going to have in mind. And that's kind of the thesis of why we thought about implementing elastic scaling, kind of in a way to break that paradigm where cost or resource consumption was only on a recurrent basis, but it could be, like, as the word implies, more elastic and more based on demand. So this is actually a pretty new development, both within Polkadot and within the blockchain space. So we're still to see like how it performs in real world use cases. But it's definitely something new, and we're very excited to see how people make use of it.
And before we're going to double click on that demand, what are the drivers behind that demand for block space? Before that, Nico, could you give us a quick overview of Velocity Labs DeFi Builders program and where you fit in the picture?
Absolutely. So as I mentioned in my intro, so Velocity Labs, you can see as the BD arm of Polkadot, and we're specifically focused on DeFi and infrastructure partners. So the DeFi Builders program was launched specifically with a big catalyst that we're going to have in Polkadot. So in Polkadot, we're going to do one of our biggest upgrades to date, which is Polkadot Hub. Polkadot Hub is being positioned as basically the gateway of the Polkadot ecosystem, and it's going to be the first time that developers are actually going to be able to deploy smart contract applications directly on Polkadot before we kind of push them over to the parachain layer, to Moonbeam, Akala, smart contract parachains. But now app developers are going to be able to enjoy the benefits of actually deploying directly on Polkadot as a dApp developer. So we're basically in a position where, as a let's call ourselves legacy ecosystem, because we've already been around for some time. We're just bootstrapping a new smart contract ecosystem, and it's going to be Ethereum compatible. So we wanted to launch this program. We interviewed a lot of potential builders, and we basically wanted to put ourselves in their shoes and say, okay, once you decide on what ecosystem to build, what are the things that you need the most? And we started hearing kind of the obvious things like technical support, financial support in the form of grants, liquidity incentives, VCs, but then other more niche things like, for example, bootstrap liquidity, for example, audit subsidy, and other things like hiring support. So we packaged all those up into the program, which we call the DeFi Builders program, and we're running it as a cohort base. So applications are going to close this week. They've already been open for a month or so. We've received close to 100 applications, and the idea is to start with a relatively small cohort of 5 teams that will take throughout a 12-week program, and basically give them all the tools they need to be able to launch a successful business on Polkadot.
Awesome. So now let's dive into the block space demand drivers, right? Like, we've seen the technology is there. There's plenty of block space. So what is going to be driving that demand for block space, right? How scarce is block space as a resource? And if trying to still take the perspective from a financial institution, how should you think about evaluating the quality, efficiency of that block space on Polkadot versus other chains?
I can start with this one, but I'm sure all of us have some input here. So on one of the points that you mentioned, like how scarce is block space, I think you have to look at that relative to demand. And right now there's an oversupply of block space, and I think that oversupply is mainly driven from a technological advancement. We should give some credit to Polkadot, given that we pioneered this idea of launch your own blockchain from very early on. But as you've seen today, like now there's a lot of options for developers to just take something already existing and just deploy their blockchain, either as a standalone blockchain, as a layer 2, as a subnet, as a, unit Cosmos chain, you name it. There's 100 ways you can do it. And people are taking that optionality, right? The barriers to entry to launching your blockchain are practically zero from a both capital standpoint and technical standpoint. So that's created an oversupply of block space that hasn't really met up with the demand. Now, I think there's been a lot of catalysts recently that has made that demand start to uptick. One which they've mentioned initially was the regulatory landscape, and that's something that financial institutions are really sensitive with. The second thing is that institutions are going to come into new technologies with a, I'm not sure if this is the right word, but with a lag effect, right? They're not going to be early adopters. They're too big too slow, have too much to lose to be quick and break things, right? So, I mean, if you take into account when Bitcoin started, let's say now we're 15 years in, a little bit more. I mean, now we've given institutions a good fair share of time for them to start dipping their toes in the water, experimenting with the technology, actually understand what it is, and finally understand like how it benefits their business, right? So I can, and probably Adam has a lot more insight into this, but institutions from an intellectual perspective now have a better understanding of what blockchains are and what they can do with them. And if you combine them now with the regulatory clarity that we're getting in the US, and that's kind of also getting expanded to other big markets, now institutions are feeling comfortable and actually going out and saying like, hey, we are going to adopt this thing, and we already looked how it benefits our businesses, and this is the approach that we're going to take. And it's not a one size fits all, right? Some are using third-party providers to kind of leverage some sort of crypto services, but on the side, some are going all in and building their own blockchains and owning the whole tech stack. And we're going to have a lot of things in between. But I think those two catalysts are one of the main things that are starting to drive up demand of block space on behalf of institutions.
Right. And I'll jump in and on top of what you said there, Nico. There's one, well, I guess I have two things to say. One, let's look at the native crypto assets, right? And what this kind of does to the valuation and price of native crypto assets. And that is Bitcoin, ETH, and in this case, DOT. Because the demand for block space is going up. And that's such a good way to put it. It's not how most people think about the value of tokens like ETH and DOT and SOL and such. You're paying to have your transaction or have your asset memorialized on chain forever, immutably. And that's a really big deal. And it's something that it's a valuation method we've really never seen before. Okay, you don't own equity in anything. You don't necessarily own cash flow in anything. What you're doing is you are paying to have your transaction, your spot memorialized there. And that's really important. It wasn't as important a few years ago when we weren't quite sure if this was going to make it, when we weren't quite sure if an asset or a currency that was literally created out of thin air to pay for this block space that no one was really demanding was actually going to be worth anything. And now we're realizing, lo and behold, we want to use these new databases. We want to use Ethereum, and we want to use Bitcoin, and we want to use Polkadot to actually understand it, to actually create these assets, to create these marketplaces. We've realized that these are more efficient. It's more efficient to go on chain to hold assets or denote your ownership of assets on chain. It's more efficient to go through lending and borrowing cases. It's more efficient to go through investing cases on chain because it is this decentralized database. And so again, step one is, what is the value of those native assets? As more and more institutions pile in, and on one hand, using the native infrastructure, using the blockchain infrastructure for things like lending and borrowing. And as we're seeing now, tokenizing stocks, tokenizing real estate, tokenizing private credit, as we see that come into the ecosystems more and more, block space is going to be more and more in demand. So you have those native tokens that are going to be more in demand. And if there aren't as many of them, my high school economics say, if demand goes up and supply doesn't go up quite as much, the price should go up. But then on the other hand, what you're seeing is all these institutions go, you know what? We like this database better. We like the interoperability. We like the fact that if I own a private investment that is tokenized, I can now utilize that to also participate in DeFi, to also participate in some sort of lending and borrowing. I can use it as collateral. It makes my assets a lot more functional for me, and they're not something that just sit behind a wall at a custodian anymore. They're assets and investments that I can actually utilize within my life. And that's what we look at as an RIA, as an investment advisor, is and what I talked about at the beginning. More and more of our assets are going to be denoted on chain. And that's not just saying we're going to choose this fancier database. That's saying it's more efficient. When you have the likes of Larry Fink at BlackRock going, we are going to tokenize more of our funds and more of our assets because it makes us, BlackRock, the largest asset manager in the world, more efficient. That's them kind of telling everyone in the world, look, we've looked at this. We know that if this can save us a little bit of money, we're going to do this, and we're going to kind of push it down on everybody else.
And Adam, how is those more and more demand for block space and like those considerations? How is that impacting the advice that Enclave gives to their clients?
You know what? In all honesty, what we look at is if our clients are going to hold native crypto assets, again, in this case, DOT for the Polkadot ecosystem, we look at things like how many developers are developing applications, or in this case, developing their own chains or something for the Polkadot ecosystem. And therefore, do we think there's going to be more transactions, more demand for Polkadot, and therefore we feel the price of DOT should go up? Again, I'm not giving financial advice. I'm not saying whether or not it's going to go up. But we look at that on Ethereum. We look at that on Solana. Do we think there are going to be more transactions in the future than there are now? And therefore, do we think there will be a demand for the native token? So that's a big part of our conversation. The other part is if our clients are interested in pursuing yield, utilizing DeFi or something by contributing to liquidity pools, or lending and borrowing, things like that, where are we going to go do that? We have to go places where there actually is liquidity. So you have to go to those decentralized exchanges or AMMs or something where there's plenty of liquidity. And if there's plenty of liquidity, obviously there's going to be more demand for that block space, because more people are going to want to get to where they can easily transact, where the transactions are efficient. As I always tell people, go back. I don't remember who said it, but why do you rob banks? You rob banks because that's where the money is. Well, you go to the ecosystems where the money is. Right? It's not necessarily always the greatest technology. It's I have to go to the networks where there's more money that I can exchange.
Yeah. I mean, it's also right. I mean, clear case of RWAs, right? Like it's people who have the assets that they can tokenize, right? There's a big part of it, right? And you can obviously, right, there's a need for having modular infrastructure, having those better decentralized databases, as we mentioned. And obviously it's been a really hot topic of, the huge growth of tokenized real world assets. And that's been a big driver of demand for that block space. So focusing on that, how is Polkadot positioned to capture that institutional capital and activity for RWAs?
Yeah, I can start here. And you're right. Look, I think RWAs today represent about $30 billion of on-chain activity, and a lot of that's private credit, right? Lowering the barriers to entry for ordinary people like myself and you, Sacha, to hold these different vehicles. Where Polkadot had focused first is that modular infrastructure, the parachain model, allowing businesses to be able to actually start and deploy their own business on chain. And that was very difficult. And Polkadot was the first to be able to solve that complexity. We didn't just spin up another smart contract layer 0 chain. But now, as Nico mentioned earlier, with the launch of Polkadot Hub, that is really going to allow for this to evolve further. And that will include RWAs. So allowing just the baseline EVM compatibility will allow for best-in-class products and structures to come on chain, and people can start to deploy tokenized assets on Polkadot, and not only just having that ability, but leveraging the metrics that surround that capability. As Nico mentioned, right, the scalability of block space, the security of the network, the efficiency of way Polkadot operates, I think is very unique. So I think that will come across with working with asset managers, working with different issuers, thinking about how we can then take those RWAs on chain, collateralize them with native USDC, USDT, and other stablecoins on Polkadot Hub, and deploy that into different strategies on chain. Mm-hmm. And that could be either into strategies on Hub itself or are other platforms like Hydration, which is a large DEX on Polkadot.
Mm-hmm. Yeah, and you mentioned private credit as a particular particularly good use case for blockchain. What makes that specific market so ripe for tokenization?
I mean, you can see like of that 30 billion I mentioned, about I think more than half of that is in private credit, because typically there's high barriers to entry for individuals to deploy into these strategies, right? Net worth, different components of actually contributing to these funds, whereby when you bring them on chain and tokenize them, you open it up to a much larger audience and lower barriers to entry, especially from a dollar perspective.
Mm-hmm. And Nico, turning to you, beyond all the noise and all the trendy things and RWAs, and what are other use cases that builders are pursuing that you see, and that you think that people are institutional investors, retail investors, like in the noise of all the buzz, are missing?
This might be controversial, including stablecoins within RWAs, but a stablecoin is a tokenized dollar, right? So I've always put it in the same bucket, and that's one which I consider it's no noise, right? It's one of the a few success stories in institutional crypto. We've created basically a asset class which has decoupled from normal digital asset price action. Like if you see the graph of asset stablecoin issuance, it's up and to the right, even independent of Bitcoin going down into a bear market. So I think that's a huge validation that there's something there. And like going back to your initial question of use cases, I think the use cases that we saw in 2018, 2020, the birth of DeFi, when everyone was talking about moving money across the world, like sending a text message, I think finally we're starting to see it. Like, yeah, a blockchain, you could do it. I can send $1 from here in Amsterdam to somewhere in, I don't know, Colombia, Africa in a minute. But there was a lot of infrastructure that needed to be built around for these things to actually be turned into products. And just now we're starting to see it, right? Where the barriers between like fiat and digital money are starting to get blurred, when more currencies are starting to go on chain, when more banks are starting to actually accept crypto as an asset. So we're starting to see a lot of advancements that are making this stablecoin use case just much more attractive. And then in terms of Polkadot, we just feel we have a really good chance from a technical perspective. As we've mentioned several times in this podcast, the quality of block space in Polkadot it's pretty good for institutions. It's available, it's cheap, it's scalable, it's flexible. And I think the part that we were lacking was more on the infrastructure part. The fact of not being EVM compatible just hurt us on that front. Infrastructure providers kind of built their businesses around an EVM-centric ecosystem. And so we didn't get the infrastructure that was needed for products to be built on Polkadot. And that's one of the reasons why Velocity also focuses a lot on infrastructure, and why we're launching Polkadot Hub as an EVM blockchain. So we're starting to solve those issues, and we're hoping that we're going to start seeing an uptick of new use cases being built on Polkadot.
Mm-hmm. Yeah, I mean, and what transpires in a lot of your responses from Dave, right, is like really access, right? How do you get access to private credit? How do you get access to, those dollar-backed products, and how do you allow to move that around really easily? And that's really where blockchains make a lot of sense. Now, what about global equities, right? How can blockchains, how are they positioned to provide access to those global equities in a way that traditional infrastructure cannot?
So I'll say this. I think there's two lenses where you can look at this. One is that crypto is pushing the boundaries of financial innovation. And the other one is that crypto is allowing other people to basically catch up. A lot of what we've mentioned is catching up, right? And even in developed countries like the US, Europe, as a retail investor, you have products where you can get access to some sort of private credit, right? For sure, you have products to get access to equities. For sure, you have access to options, et cetera, et cetera. All these platforms are very available, easy to use. We saw it in COVID, et cetera, et cetera. These has been instruments that have been around for a while. But if you look at the emerging world, none of these people have gotten access to these instruments. So when we talk about global equities, now all of a sudden, an instrument like a stock in the biggest equity market in the world, in the US, can now be accessed from anywhere in the world. And that's very unique. But that's an accessibility story, right? Then there's the other part that I mentioned, which is pushing the boundaries. And this is a lot less clear. But for example, pushing the boundaries for me is creating net new instruments. And that's what perpetuals are. Perpetual futures are a net new instrument that is native to crypto that I'm sure is going to start permeating the traditional world. And that's more like pushing the boundary of finance in general, which I also think is super interesting. But like adding access to instruments that have been available for a while is much more interesting for me, in my opinion.
I think all these conversations around access and opportunity, whether it's equities, whether it's private credit, whatever, it's, as you said, it's giving more people the opportunity, first and foremost, more people the opportunity to participate in investments and in, I guess, storing their money in ways that they haven't been able to in the past. And that can be in the developing world where they might have access to equities like NVIDIA now. That could be even in the developed world here in the US. Almost nobody that is a traditional finance investor, the kind of person that goes to their job, comes home, has a 401k or IRA or something, almost none of them have any allocation to private credit or private real estate or anything like that. And this is going to give them the ability to have that access because it's made easier, because the blockchain, the transparency, the ability to instantly settle, the ability to custody themselves. This is all going to give them that opportunity. But then what Nico says is the next step after that is what do we create next? What do we create next that is some sort of financial instrument, or in reality, just the ability to move money from where it's less efficient to where it's more efficient? How is blockchain technology going to give us that opportunity? We already kind of see it in lending protocols, in LPing into various DEXs and such. That doesn't really exist in the traditional world. I don't get to provide my money. I don't get to provide my assets as liquidity for exchanges usually, or at least not to my knowledge. I'm doing it, but most people don't realize they're doing it. So I think, what we're going to see is these novel instruments, these novel financial instruments, like we're seeing with Polymarket. Like that's a really good example, right? Polymarket today got a $2 billion investment from the company that owns the New York Stock Exchange. Well, we've never had
big news,
right? We've never had prediction markets as an investment opportunity, but I posted on Twitter today. That's going to be in your portfolio at some point. Like, how is that any different than options and hedging and everything else you do? So that's going to be something we haven't seen before. Imagine if your business or even your personal financial life were going to take a turn, maybe not drastic, but going to be impacted by the next presidential election. Well, then you can actually invest or have in part of your portfolio some prediction market based on the election that says, if this party wins, yes, it's a net negative for me in my overall portfolio, but I'm hedging by saying if that party wins, I'm going to get some sort of financial gain from it. Those are the kind of things we don't usually see. We move that off into something like gambling, when in reality it's just going to be a smart financial decision at one point.
Mm-hmm.
Yeah. And I think you also have the component of the compliance aspect of things too. All these products are regulated permission products. So how do you turn those into permissionless? How do you think about the smart contract compliance logic on chain in order for people to kind of have this broader access without those initial barriers to entry, which will be really interesting. And I know there's been some evolution with like ERC 3643 and those compliance engines. So I think we're going to see a lot more of that. And I think, Paul Atkins and them will start to kind of make these standards, I believe, to allow for just much easier on-off ramps.
Yeah, and I mean, when you're talking, I think also the CFTC, right, when it comes to events contracts and diverse, edging specific risks, right? So what I hear is there's the hedging part for risk management, there's the diversification, access to more instruments, and like in modern portfolio theory, having a better sort of like market exposure that's more diversified, and then moving things around more easily and better manage your collateral, right? Anything we're missing?
No, I'm going to hit on something Dave said. I should have said compliance. I'm actually the chief compliance officer of my RIA, so that should have stood out. But the idea that everything is transparent, the idea that we have up to the second information on all of our investments, on our holdings, on whatever's going on with our money, I think that's really that's going to be very important. And you couple that with the way custody works on chain, the fact that I can kind of control my own custody if I want to, and therefore I can kind of control who has access to that information. I think those two aspects are going to be critically important.
Yep. And well, for this to happen, you need good plumbing, right? And you need that plumbing to be able to compatible with all the taps from financial institutions, and go from there. So and maybe that's a question for Nico, maybe Dave might have a few things on this as well, as like, how do you make the plumbing really for DeFi really plug and play for those institutions?
It's Nico's world.
Yeah, I mean, DeFi for the people that aren't in DeFi, it's just too complex. Even for the people that are in DeFi, like I still get confused with where my money is because I have it spread all around different protocols and blockchains and different forms of digital dollars and et cetera. It's still a mess. So I think a lot depends on us improving the UX, and you're already starting to see shows of that. I have several examples. One of the ones that I like the most is Phantom adding perpetuals to their UI, and they're actually adding hyperliquid perpetuals. So if you use them, you don't really feel like it's another blockchain. If you're from Solana, you don't feel like you're actually moving your money to hyperliquid. They completely abstracted that away. They abstracted a lot of the unnecessary complexity that perpetuals as a product have, and they just show you the necessary parameters that a user needs to be able to open a long or a short position on any token on hyperliquid. And that's still kind of very crypto native, right? We still need to get a layer above, which is exposing these very complex systems in a way and in a language that absolutely everyone can use. I think that's the biggest piece. I think the ecosystem has advanced a lot in terms of infrastructure, custody being one of them, wallet infrastructure being another one, interoperability. That was something that I think in the last 1 or 2 years has improved greatly with things like CCTP, like more solid interoperability protocols, intents and solvers, all these things that kind of allow the lines between all these blockchains to kind of be blurred. All those things have improved a lot. So I think the biggest missing piece is just improving UX, improving the abstraction of these very complex systems. And I think that'll hopefully unlock a lot of more access to DeFi for the regular people.
Yeah, and I think it's the data availability too. There are, I think, the TIE has a great dashboard where we kind of build out a lot of different things on there as well. But how do you give that data availability to someone that's running different strategies across tons of different chains, like Nico said, to be able to kind of look at that information, understand where their progress is, what are the returns looking like, how can I export that data, how can I analyze it, when do I look at it for tax purposes? In the US, they're starting to come out where every wallet is its own cost basis, so all of these things get so complex, and I think it's going to take some time for that to evolve.
Yeah, and also at some point, right? Like the vast majority of of the money being managed, which is pretty big compared to just crypto, right? So let's look and double click on RIAs, right? And I mean, Adam, that's your realm. So if you try to look at the bigger picture, right, like and try to get out of the crypto echo chamber, right? How have you been positioning blockchain, crypto, quote unquote, assets to RIAs? What was it a year ago? How has that been evolving over the past year? Where do you think those conversations are headed?
Well, I will tell you this. I have had so much more interest in our courses. I've had so much more interest in other RIAs coming to us and determining how they can work with us and use what the infrastructure we've built, or I'll say this better, the infrastructure we've kind of put together, stacked together to be able to manage client assets on chain. Where it started was more and more RIAs being amenable to just holding, Bitcoin and ETH, right? We had ETFs approved. It was kind of this blessing finally from the SEC to say these are okay. And not only, of course, did billions and billions of dollars pile into the ETFs, but they also piled into institutions, these DATCOs and such that are just holding these crypto assets. So the fact that you have ETFs, you have BlackRock and Fidelity, and obviously the likes of Bitwise creating these ETFs that have had billions, millions of dollars poured into them. You have institutions buying the ETFs. You have institutions holding Bitcoin and ETH. I think that's a big sign to RIAs that this is not going away. You really have to learn about it. And we're honestly just in the beginning parts of that. We're just in the beginning pieces of many RIAs in the US and even investment advisors around the world looking at crypto assets and how they fit in portfolios and really learning and understanding. I think where we're going next is going to be more on-chain capabilities. Do you want to hold those assets on-chain? Do you want to earn some yield on them? You're already seeing RIAs ask about ETH staking. And so that gets us to the next gen of how can I hold a stable coin and generate yield through various liquidity pools or various yield strategies. And as they see more and more of those opportunities, as they see the opportunity to invest in something like BUIDL or private credit or something, they're going to go, how can I get access to that for my clients? I can't get it through Schwab or Fidelity. How do I get it? And we're going to say, you got to go on chain. That's just part of the deal. You have to go on chain and you're going to have access to so many more opportunities for your clients. So it's getting there. It's going to be relatively slow. They have to wait for compliance. They have to make sure that everything's on the up and up. And keep in mind, it's a totally different custodial structure than we're used to. So it's going to take a little while for most RIAs to get there. And it's probably going to be kind of like the internet. Like you're going to get there when it's obvious and you don't really have a choice. But we're trying to get ahead of it a little bit and help actually build out the tech and build out the infrastructure that we need such that it can fit within compliance, it can fit within regulation, and it can fit within usual RIA workflows.
So are these the main barriers that they face, or their clients face?
The main barrier in the past obviously has been regulatory approval and compliance. Right now, it's, I think, much more custody and workflows. It's not real easy to manage client assets on chain and fit it in within your reporting structure, right? I'm required to send reports to my clients at least once a quarter. And as much as you think all this transparent data is easy, it's really not easy to report on strategies in morpho vaults or something like that to my clients in the same report that they have their, NVIDIA stock and their S&P ETFs and everything. So it's a lot of it is workflows. A lot of it is compatibility of systems and the ability to parse out all this data and go, what is important to my clients? And then there's safety and security, right? You're moving assets from a traditional custodian that you know and trust, like a Schwab or Fidelity, to either on chain or, to these networks, and you hear about them getting hacked and exploited, and you have to take into account safety and security. You have to take into account insurance. It's not the easiest thing to go buy a whole bunch of E&O insurance for us. So it's a lot of RIAs kind of protecting themselves, learning. There's a lot of education that's needed. And then just being comfortable with how my client's money is going to flow and how I'm going to explain to them what's happening.
And so what does it look like to have a safe, compliant, operationally efficient, understandable wallet setup for an RIA and their client? Do you need a Fidelity to do it? Do you need or can it be more decentralized? What do you need?
So we use some of the qualified custodians that you've heard of. Again, I mentioned Anchorage, BitGo, Tetra up in Canada, Zodia, for the most part in Europe. It can start with qualified custody, but those custodians, they kind of limit in terms of what you can access from a DeFi perspective. BitGo, I think just this week or late last week or something announced that they're going to have more DeFi capabilities. Going on chain involves making sure you have that security, making sure as an RIA, I never have control over the keys, right? So it's something like an MPC wallet, multi-party computation wallet, such that I can kind of have access or help you make your investments or make your investments for you, but I can't take the money. I can't move it to my own wallet. I can't move it to my buddy's wallet or something. So being able to put those guardrails, which we all know programmatically we can actually do. We can do it better than the traditional financial system can do it. But we just the RIAs have to be comfortable with what that new technology looks like and the applications that allow you to better manage. Nico mentioned earlier how hard it is to kind of use DeFi, even if you're native to it, even if you've been using for a while. If you're on multiple chains and multiple DEXs and L1s and L2s and everything, it gets difficult. And so as an RIA, we have to be able to look and manage all of that. We have to be able to look over it. We have to be able to report on it. We have to be able to keep it safe and secure. And that's just utilizing this self-custodial technology and fitting it in within the regulations and guardrails that we have in place.
And so how can RIAs, use all the tools and that blockchain offers, especially on Polkadot, to do all this, to, beyond the wallet, also manage client risk, income flows, diversification?
That's a really good question, and one we're trying to solve on a daily basis, right? Is get the right tools, understand how, again, we can look at all this data that we have and determine what the right mix is, what the right risk profile is, what kind of risks we're taking. The beauty of the transparency and the beauty of instant settlement is we have instant access to what risks we're taking, but we don't necessarily know how to parse that out and make it fit within what my client needs. So you ask how RIAs are going to do that. I would say step one, come talk to us, because I feel like on the forefront of trying to figure out which technology we need to stack on top of each other or with each other to make that work and fit within compliance and regulation. We're willing to kind of push the envelope and so that we can help our clients that want to remain on chain and want to have assets invested on chain. Other than that, it's going to take some time for folks to build the right tools that kind of mirror what we've seen in TradFi for a while, and produce reports and produce risk profiles and produce asset management tools for the on-chain world.
Yeah, I think. Oh, perfect. I was just gonna say,
hey guys,
we got Dave back.
Technical difficulties. The laptop shut off, but I'm back.
It happens. Well, hopefully next time your laptop can run on a blockchain. Hopefully. But I think we pretty much covered all the main topics we wanted to cover today. So let's look ahead, right? What over the next year, what do you think will have the greatest impact on either on RIAs, on diversifying client portfolios, improving risk management? What do you think is going to be the most impactful in the coming year?
I mean, I can talk about maybe something with RIAs and in general other participants coming into the ecosystem that are not native crypto. It's, I think, really showcasing proof of concepts, providing that comfort and that confidence for people to understand what does it mean to deploy this type of strategy on chain. You know, thinking about risk tolerance for client assets. If I'm speaking on behalf of like Adam on that side of the house. I do think more assets will come on chain. I do think more these permissioned assets will become permissionless, and that will be able to be utilized for liquidity across various strategies across DeFi.
From my end, so I mentioned kind of the two ways in which crypto is expanding the pie. One is by increasing accessibility, which I think that's already in motion, and we're seeing great progress there. On the pushing the boundary of like finance in general, I think that's a little bit more questionable, but like the perpification of things in crypto.
All right, I think Nico also froze. So Adam, if you want to go ahead.
Yeah.
Like
if we're talking about RIAs, like RIAs just in the U.S. control, I don't know, hundreds of trillions of dollars, right? So and we get questions all the time. How can you, meaning us, Enclave, bring more demand, bring more money to our ecosystem? Can you start allocating on chain? And what I tell people is, like, there is not a lack of supply of things we can invest our clients' money in on chain, right? There's plenty of supply. There's plenty of tokenizing of real world assets. There's plenty of liquidity pools and perps and everything else they can do. If you're really going to bring RIAs on, one, we have to be able to test it, right? We have to be able to test all these ecosystems. We have to be able to see how it's going to work within our workflows. We're going to have to see how reporting looks. We're going to have to see how it fits within risk profiles. And we're going to have to test to make sure everything's safe and secure. Once you can make it easier for registered investment advisors, for investment advisors to move their client assets on chain and manage those and feel safe and secure, then you're going to have more RIAs using it. But just being able to shout, look, there's instant settlement, or look, this investment has gone up 182%, or you can yield 28%. That doesn't help, because the main thing that RIAs need to do is not lose their clients' money. And if there's a chance that they're going to lose 100% of the investment, they're not going to do it ever. Yeah.
And it's always the career risk as well, right?
Right. And the career, like, there's career risk now in almost not allocating to Bitcoin and ETH, right? But you don't have that career risk in not allocating on chain right now, because I can get my clients, 4.5% in treasuries without going on chain with zero risk, right? And you might go, well, but the risk is the devaluation of the dollar. But most people, like, that's not a big deal, right? I pay my life, like, my life is funded in dollars. I'm going to get paid more in dollars, all of those things. More of it is being safe and secure and easily fitting into what my workflows are, both from a regulatory perspective and just from a client management perspective.
Mm-hmm. Yeah, so I want to let Nico finish what he was trying to say before, and then we'll just do a final quick fire round on what the biggest tangible benefits are for RIAs. But Nico, please, if you wanted to finish what you were saying.
Yes. So I think where I got caught is when I was talking about the perpification of markets, which is basically perpetual futures permeating more markets than are currently available. Right now, it's very focused in just crypto native assets. We're seeing some products started to explore with indices, with bonds, with FX. And I think that trend is going to continue. I just think like perpetuals are a superior product than options. It allows you to expose different views of the market with much less complexity. It's superior than futures because it's stated futures. So if you want to have a longer view than the future that you're currently exposed to, you have to roll it over. There's just a lot of benefits. So I do see this instrument just kind of permeating financial markets much, much deeper. And we're just seeing the start of it.
Okay, and the quick final round of, any quick take, anything you want our listeners to keep that idea in mind as we wrap up, and what do you think the most tangible benefit is going to be for RIAs?
I can start the fire round. I think just looking at Polkadot, being at the forefront at the very beginning. Why did Gavin leave Ethereum to build Polkadot? The progress we've made, I think the traction on where we're moving and the resilience of the ecosystem. I think we've held true to being a Web3 ecosystem, what we're building, our values, and where we see, I think, the future. And with the launch of Polkadot Hub will be that initial entranceway for organizations like RIAs to help think about proof of concepts, showcasing optionality and different strategies they can deploy on chain. And we're here to help support them navigate that, because it's not only helping them, but it's helping us as well as an ecosystem think about what matters to the end users, and that's through Adam and his team, but also his end clients. Like how can we get better as an ecosystem? And I think I'm excited about that journey.
On my end, I echo a lot of what Dave said with regards to Polkadot. I think crypto ecosystems generally have a big Lindy effect. So as long as you maintain relevant for as long as possible, and you're able to iterate on your product and iterate in your technical solution and iterate on your go-to-market, you'll slowly be finding your edge. And I think that's what Polkadot is doing, is already a very mature Web3 infrastructure, probably one of the most matures out there. And I think we're starting to address some of the issues that I think were holding us back in terms of adoption. I think Polkadot's going to have a big year coming forward. And in terms of ROA, I think Adam has touched on a lot of points, but I think education starts with just an overall interest in the asset class, and that's kind of the hurdle that we got passed by, just being blamed as just speculative and as a on-chain casino. I think we're past that, and people are starting to take us seriously, and so that's starting to get people curious. And then once they're curious, as long as there's enough people like Adam in the world kind of teaching people about the technology and the products out there, I think that's just going to get people more and more interested about it.
All right, I'll finish this up first. Nico, my wife is happy that there's only one of me in the world, and only one person like me, so we're good at that. But I think the part of the important piece is, Nico, you touched on it. This is not speculation anymore. It's not gambling. It's not a casino. Now we're seeing where assets are, the networks, the databases that are being built. These decentralized databases are actually being utilized. They're working together. So it's actually moving money around. It's not a novel thing anymore. And when you have networks like Polkadot, groups like Polkadot that have gotten to, fortunately or unfortunately, sit back and almost be passed by at one point, and now go, okay, we're ready to build for what the current state is. And the current state is not, hey, you can, make, 428%, or look how much Bitcoin went up or something, but it is, people are actually utilizing this particular database. Let's build for that. Let's build for how people are utilizing it now. Let's build for the current regulations. And if you're looking to get in with RIAs, you can build for what we need, which, as I've said, is safety, security, transparency, ease of use, ease of fitting into workflows. It's not, building the next casino. It's building a usable system that actually allows us to help our clients be more efficient and safe and secure with their money. That's really what we need. So as groups like Polkadot are able to build for what we need, we can start bringing our trillions of dollars on chain.
Awesome. I think that's the perfect way to synthesize everything we've discussed and really leave on a strong note here. So thank you so much for all of you for joining us today, to all the listeners. Thank you Adam, Nico, Dave. We had a lot to unpack today. It was a great discussion. Looking forward to seeing you next time, and we'll wrap up for today. Thanks, everyone.
Thank you.
Thanks, Sasha.
Thanks for the
Appreciate it.
invite.
Thanks, guys.
Woo!